Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. If you're an advisor, you know just how many hats you have to wear. Sales, marketing, portfolio management, relationship building, accounting, a dozen other functions that fall on your plate, often all at the same time. That's where YCharts steps in. YCharts is a one-stop shop for all your investing research and client communication needs. With its intuitive interface, pre-built research templates, and custom reporting tools, you'll save hours of time each week and be equipped with the tools and data you need to uncover better and newer investing ideas. Click the link in the show notes to start your free YCharts trial and get 20% off your initial subscription. New customers only. Welcome back, everybody. We got another awesome show. Our guest today is Owen Lamont, portfolio manager at Acadian Asset Management. He's also been on the faculty of Harvard, Princeton, Yale, University of Chicago. He writes the blog Owenomics, which is one of my favorite weekly reads. You can subscribe to it for free online, and be sure to listen to him read one of the first pieces on the Best Investment Writing podcast. Owen's done a lot of research on all sorts of stuff: bubbles, market efficiency, behavioral finance, shorting. We're going to cover all of it today. Owen, welcome to the show.
Great to be here. Thanks for having me.
You do a lot of writing. You have a way with words. We'll hopefully work in some Seinfeld and Star Wars at some point here. But given the romping and stomping going on in equity markets, we've been talking a lot about just how much U.S. stocks have compounded over the past 15 years. It's really been a wonderful period. We did a post on Twitter asking investors what they thought U.S. stocks have returned since 2009. Said, do you think they've doubled? Do you think they've tripled? And the answer is darn near a 10-bagger, which is really astonishing. So a lot of people, they hear that and they think, oh man, I lived through the 90s. This has got to be a bubble. You talk about this topic a lot. How you feeling? Are we bubbly-licious right now? Or are we in a crazy town, or not so much?
First of all, the 10-bagger was also probably mostly true of earnings too. So it's not like the stock market has gone up tremendously out of line with fundamentals, but it is definitely true today the market's not cheap. So it's not like this is a great buying opportunity. But I would say, to me, the word bubble, they're like symptoms of bubbles other than valuations. So I'll let you and your listeners judge. Like, they can look at the CAPE ratio or whatever, decide whether it's too high. It's high, it's not super high, but there are other symptoms. So I would say the symptoms aren't all there, but the stars are aligning for a bubble. So I think that you could argue that if we're repeating the 1990s, we're not in 1999 or 2000 yet. We're still in the early innings. You could make the argument that there's strong fundamentals that justify today's high prices.
Well, you talk about the Horsemen when valuation is just one, but you talk about other things. You talk about bubble beliefs. You talk about issuance. You talk about inflows. If you had to characterize kind of 2024, how do all those coincident indicators line up today for what we're looking at for U.S. stocks?
There's the four horsemen. The first one's valuation. So valuation is high. It's not like amazingly, mind-blowingly high. So that's the first horseman. It's getting bubbly. The second thing is beliefs. So I would say my definition, people use the word bubble to mean different things. But my definition of a bubble is it's when everyone knows, or many people believe the market's too high, but they're buying anyway. And we are getting closer to bubble beliefs. So it's not as bad as 1999, but there's this Yale survey. So it was started by Bob Shiller many decades ago, and now it's run by Yale SOM. It's called the Yale SOM U.S. Confidence Survey, Stock Market Confidence Survey. And they ask individual investors, do you think the market's overvalued? And the level we're at now is pretty high. Not as high as 1999, not as high as 2021, which I also think was a little bubble, but it's getting higher. So bubble beliefs, they're there. So my two other of the four horsemen are, do we see issuance by firms, where firms are selling equity, and do we see entry of new people? Are retail investors coming in and buying equity? Those two horsemen we don't see. We don't see a huge wave of IPO. We haven't seen a huge wave of IPOs or SEOs in the US. US companies are still like paying dividends, buying back shares. They're not getting money into the stock market. So that's what makes me think that it's perfectly fine to own stocks now. We're not at a bubble because we don't see a wave of issuance. If 6 months from now we see this huge wave of issuance, then I would change my tune.
Why aren't companies IPOing? I always watch from afar the bankers talk about, well, the IPO window's closed or it's open. And if you're a good company and you look at some of the best companies in history, like Google and Uber, like they came public during some big downturns and big bear markets. So I'm always curious why, if you look at me, other than the fact that it seems miserable to be a public company, it'd be my nightmare. So I get why they don't. But on average, once you get to be, I keep seeing these offerings for SpaceX at a $200 billion valuation and said, look, this company should probably be public at this point. How do you think about that with IPOs? Is something structurally changed, or is this more just kind of the same with the cyclical nature of this sort of banking public-private market relationship?
So I do worry something structurally changed because of private equity and people don't need to do IPOs anymore. But that was also true in 2021. And we did see a huge wave of IPOs in 2021, especially if you're going to count SPACs. So that was only 3 years ago. So it's not like people have stopped due to SoftBank or whatever. People have stopped doing IPOs. But the structural stuff is real. In many cases, maybe they don't need to issue equity because they're so profitable. That's probably not true of the young firms, but the Magnificent Seven are pretty profitable. So I think part of it is just the stock prices are not high enough. But let's say stock prices double tomorrow. Then you would see companies starting to issue equity, existing companies, and you would see people rushing to market. If the stock market doubled today, it wouldn't happen tomorrow. It takes time to get an IPO and stuff. But it doesn't feel, in that way, it doesn't feel at all like 2021 and 1999. I don't know what it would take, but it doesn't seem like we're there.
It's interesting you mentioned 2021, and we'll stick on sentiment for a second, because sentiment's always like a little bit squishy when people talk about it. They talk about the magazine cover indicator. You got your idiot friend that's buying some crappy crypto coin. They're pitching you on some stocks that you know darn well are probably going to go down 90% at some point. You just feel the animal spirits. But those things are hard to quantify. But you mentioned there's a handful of these surveys and ideas. We used to talk about the AAII survey or institutional investors, but there's one you mentioned that I don't know that I've spent much time with that I think is actually pretty interesting. We'll post this link to the show notes, listeners, but this was the confidence and valuation confidence survey. And this is from Yale, and you mentioned it, but it's cool because it asked people, is the market overvalued? And the average is like kind of a coin flip. I think it's 43%. And this is one of your articles. But there's times where it's like people kind of know when things have gone nuts. So April 2000 and June 21 both said 70% said that it's overvalued. Whereas in May 09, it was 18%. This survey is pretty good. So how do you think about sentiment? How do you think about quantifying it, a squishy kind of topic?
First of all, that survey has an amazing track record. And maybe it's just coincidence. And I would think survey evidence is getting less reliable because people aren't answering their phone or whatever. But it seems like scarily infallible, this survey. And one thing I should say about the survey is those numbers you're quoting are 6-month backward moving averages. So it's a slow moving thing. But yeah, I think the way I would restate what you said is people know when there's a bubble. Like in 1999, it wasn't like a mystery that there was a bubble. Like everyone was talking about it. And maybe they disagreed. They disagreed whether there was a bubble, but everyone was aware that a lot of people thought there was a bubble. So part of it, I mentioned Bob Schiller has this whole research agenda or idea of narrative economics. Part of it is the narrative. Is there a narrative that there's this, huge transformation of AI? Is everybody talking about it? Are they talking about it in the gym? Are they talking about it in the bar? So that's sort of like the shoe shine boy indicator type of thing. When you talk about the squishiness of the surveys, if I just did a survey that was a one-off, I would not trust that at all. It's like trusting the political polls. It has to be a poll that it has a track record and that you see it change over time. So I do worry that if you designed a specific custom poll, like you said, it's a coin. When you ask people, is the market overvalued? Half of them always say yes. So you really need the context of a long history.
So in one of your pieces, you talk about the famous George Costanza from Seinfeld. And for listeners who don't know Seinfeld, one of the best shows ever, was that Jerry had a buddy, Costanza. And so your quote was like, my advice to you is find George Costanza in your life and listen carefully to his advice. Ask him which stocks to buy, which job to take, and where to live, then do the opposite. Costanza notoriously kind of had bad ideas, plans that never worked. Talk a little bit about that and also the role of sort of the retail or quote, the dumb money in sort of some of these periods. I mean, we definitely saw it in 2021.
When I used to teach, I used to always talk about the doctors and the dentists, because the doctors and the dentists, they're rich people. They have money. They are smart, but they have like ideas about how to invest. And so in 1999, it was the doctors and the dentists who were buying tech stocks. So you want to find the doctor, find your dentist, ask him what his idea is, do the opposite, would underweight the industry he wants to go in. Now, I'm not sure whether the doctors and dentists are still the correct population anymore, because they're still have money and they still think they're smart, but a lot of them have switched to like passive things. So I think the equivalent now is probably some young crypto bro, younger male who thinks he's really smart, is forward looking and is, trading and from his mother's basement. Maybe that's like the stereotype of GameStop. January 2021. So I don't know what the equivalent population would be, but it's someone who is super excited about whatever the exciting new idea is. I guess it would be AI now or maybe crypto. And they're all in on it. They're just holding 3 stocks. They're trading them constantly. That is the track record, is that type of person loses money. They're trailing the market. And so another way to think about this, if you think of a successful hedge fund, if you think of Citadel or whatever, who are they trading with? They've got to be trading with that guy. So to me, retail investors are the George Costanzas. They're the people you want to find and do the opposite of. And I think what's complicated about that, like from a practical point of view, is that the retail investment has changed so much over the years. Like in 1995, they started with phone trading, and then they got the internet trading. So the whole nature in the 90s, that changed. And then we had mutual fund flows, and mutual fund flows were the way to figure out what the doctors and dentists were doing in 1999. Now, not so much mutual fund flows. It's something else. It's Robinhood accounts. Maybe now it's options. So I don't know what the next iteration will be, but if there's some cool gamified app where your Uber driver or the young, bold man in your life is trading stocks, that's where I would want to take my George Costanza cues from.
And if you find one of these listeners, don't tell them. Keep them sacred, close to your heart, and just listen to them, because it's a useful piece of information. You get echoes of this. You look at Pete Rose recently passing away, and all of a sudden, this arc of history where gambling now is so pervasive. We had the vice presidential debate last night, and you could place a wager on which candidate would say what state first. Everything has become gamified. Everything has become gambling on sports, a sponsorship. It's fully engrossed in all parts of life. And the challenge, I think, is separating that from, hey, I'm going to put my hard-earned money to work in a thoughtful way, and maybe this is entertainment over here, whatever, but getting the guardrails. We've mentioned Robinhood as a bit of a nemesis over the years, and I say, I bet at some point they're going to be advertising that you need to be trading options in your IRA and some of these type of topics. And so you see all these products proliferating, 0-day options and all these kind of gambling 50-leg parlays that people are talking about. Does this influence how you think about markets in general?
That's a fascinating question. And we do have research. The research is, maybe it's going to guide us. Maybe we're in such a weird situation that it's not applicable. But let me pose the question first. The question is gambling, let's say gambling on the NBA. If you're gambling on the NBA, on basketball games, is that different? Is that going to reduce your use of Robinhood? So is it a complement or is it a substitute? Is that you gamble on basketball and then that makes you want to, trade GameStop more? So the pandemic experience suggests it's a substitute. If you can't gamble on basketball, you're going to gamble on GameStop. And we've already mentioned crypto. Like, If people are gambling on crypto, are they not gambling on the stock market? So there's some people who think that sports betting is terrible and people are getting addicted to it and that they're going bankrupt. There's plenty of people who are hurt by sports betting. But in the narrow question of does it help the stock market, you could argue it helps the stock market because it takes the crazy gambling out of the stock market and puts it someplace else. A fun piece of evidence comes from Taiwan. This is research done by Brad Barber and Terry O'Dean and their co-authors. At one point, Taiwan has super great records of every trade and every person. There's an ID code. So in Taiwan, they have like a godlike understanding of every stock trade and every person who did it. And they calculate, first of all, they calculate retail investors lose money in Taiwan. They lose tons of money in Taiwan, 1% of GDP or something that they're blowing. Now, maybe I shouldn't say they're blowing. Maybe they're having fun doing it. It's okay. But the other thing that happened is during the time that they had a historical record of these trades, Taiwan introduced a national lottery. It's like megabucks. So they introduced the lottery and stock trading went down. And of course, the lottery is not a good deal. You lose money on the lottery. But it turned out if you did the math, the amount of stock trading went down more than the amount of lottery tickets, so that the people of Taiwan ended up losing less money. And if they had an equal amount of fun from the gambling, then that was good for society. So it's true that we live in a gamified system, and we've seen a gamified trading system, and maybe it's just temporary. Maybe it's going to die down and the stock market will go back to being a sober, maybe sober is the wrong word, but a more rational, less lunatic, fringy activity. You're old enough to remember when the stock market was less crazy.
It's tough because these things definitely go through cycles and regimes. And you mentioned the late 90s and 2021. 2021 happened, and I was like, I never thought I'd see this again in my lifetime, because late 90s, I was in university, but we talk about this, like that was full on. CNBC was on at every pub and restaurant. You had my professors were trading stocks during class, on and on. Everyone, it was like a stock part of their mind. So it's definitely crazy. But then you have this bear market, washes out, everyone forgets it, goes back to like their normal day to day. And then obviously the 0809 was traumatic for, I think, many investors and caused them PTSD for a long time. But then 2021, it was like this new generation of young investors that didn't have those.
Didn't have immunity. Yeah.
So I don't know. I think a lot about gamification, except thinking of gamification in like in a Thaler sort of way, like nudging you to doing the right thing as opposed to trading 0-day options. How do you save as much as possible and put it to work in some sort of long-term fun? But I don't have any good answers yet.
Blaming Robinhood is kind of like blaming McDonald's for people eating burgers and being unhealthy. I mean, McDonald's is just giving people what they want, which is the burgers. And Robinhood is just giving people what they want, which is like a fun experience. So I mentioned the 90s. Like part of it was no one's ever traded on the internet before and it's all exciting and then it wears off. So we do see, just like you said, that these cycles where people experience it and it dies down. Yeah.
I mean, look, we had the E-Trade baby. We had all the commercials from the 90s. I mean, you go back long enough.
Sure, light this candle. Yeah.
E.F. Hutton commercials and Dean Witter. But Robinhood gets my ire because they often project a sense of fiduciary. We're doing the right thing. We're democratizing. We're helping you. But then like, let me at every possible intersection push you in the wrong direction. So they have a special spot in my heart of not just like, hey, FYI, we are the casino and here's some Big Macs, like enjoy it. It's fun. They're like, no, we're the good guys. Anyway, don't get me started.
Did you see the movie about GameStop? Dumb Money?
I did. I watched it on the plane.
The people who watched the movie thought the villains were the short sellers. I thought the short sellers were the good guys. So it's a weird experience to watch the movie.
Let's talk about that for a second. This has to be one of the least understood areas in all of investing in finance. I don't know why, but I consistently fight battles on Twitter and elsewhere when the politicians are like these no good, dirty short sellers. And then even like CEOs and venture capitalists are often like these bad short sellers. The Palantir guy the other day went on TV, the CEO, and he's like, all these short sellers need the money for cocaine and stuff on CNBC. I'm like, have you met a short seller? They're usually like nerdy CFA types, but we say they're like the immune system of financial markets. No one at the government or journalists are going to figure out some of these, or certainly the longs, fraud and bad things. Anyway, talk to us about short selling. You've definitely had a long history, research.
Okay. Well, first of all, your experience You're describing the CEOs and the politicians. Everybody on earth hates short sellers. If you ask your mother, you describe short selling to your mother or any jury members, they would immediately say, that sounds bad, that's illegal. They want bad things to happen.
They're betting against America.
And it says in the Bible, you should not rejoice when your enemy stumbles, nor should your heart be glad when he falls. That's like, shorting is evil. So it's an extremely common, I'm going to call it a prejudice or superstition or medieval. It's kind of like in medieval times, they thought borrowing money or lending money was evil. And it's a prejudice. And it's a constant through centuries of financial history. Short sellers are evil. Short sellers are conspiring. They're spreading rumors. They're undermining the country. They're destroying jobs. You're exactly right that short sellers have historically been a vital part of detecting fraud, detecting Enron, stuff like that. I would say short sellers are an endangered species in the United States and elsewhere. The quantity of shorting has gone down. The cost of shorting has gone up. And in some countries like Korea, they've just banned all short selling. So I'm not a fundamental investor. I'm not, discovering fraud. It's other people that are doing that, and they're getting hunted to extinction, I would say. So I would say it's one of many ways in which, I don't know, over-exaggerate this, but it's possible to have a stock market without short sellers. That's what Korea has. But it's one of many ways I think our market is degrading a little bit and getting less efficient. And the next Enron is going to be harder to find if there's not short sellers there to find it.
I feel like a lot of the short seller types at this point are like, you know what, I'm just going to go the whistleblower route. I'm going to identify some companies and offerings that are clearly doing things that are suspect and go that route, because I don't have to portfolio manage or risk manage this. I don't have to deal with short lending desks. I'm just going to find the bad guys and rat them out and get my reward.
You're talking about the SEC's reward or whatever, yeah.
They just had one the other day that was like, wasn't like $200 million reward or something? It was something just astonishing.
If that system worked and was fair and transparent, that would be great.
Yeah. I think you can now, you used to have to go through a lawyer and it'd be a huge pain to try to report. I think you can now submit individual submissions. Anyway, we'll see if we can do an episode on that. Listeners, if you got any good whistleblower buddies that have done it and been through it, it would be a fun episode. But the short selling world is interesting. You wrote an article that was talking about how shorts work, and people's brains always melt down about borrowing stock. And you talk about, hey, you could have a stock that you borrow and you have to pay to borrow it, listeners. So let's say you want to short Microsoft. Well, you may have to pay 4% a year to borrow that to short sell it. I don't know, making up the number. But you were talking about this article that in some cases, you could borrow a stock and they would charge you over 100% per year.
First of all, it's not just 100% a year, it's 1,000% a year. So it's like mind blowing. So the way that works is, let's say you're going to borrow stock ABC. I'm the owner of stock ABC. You're the borrower. You're going to come to me and say, please lend me that. And I'll pay you, let's say it's a $100 stock, price is $100. I'll pay you $1 a day. So $1 a day, that's 1% a day, that annualizes to more than 100%. So that's how it's possible to be more than 100%. It's, if you think of it in dollar terms, is less mind-blowing. So like if it was $10 a day, it would be many, many hundreds of percent. So I don't want to exaggerate and say no large cap stock in the S&P 500 would ever be like that. They would be like 50 basis points annualized. But there are some stocks and some ETFs that are just hugely expensive to short, and especially in times when you really want to short them. So I like to say that the securities lending market works great unless you want to use it, in which case it works terribly. So you only want to use it when the stock is tremendously overpriced. Like, let's say, for example, there's a stock that an insider is going to sell. It's got very low float and the float is going to go up. So it's like very predictable. In that situation, the securities lending market, the cost of shorting will reflect that. So it's always hard to make money. And if it was easy to make money, prices would equilibrate or the cost of shorting would go up to prevent you to make money. So it's part of the general idea in finance that finance is a competitive place. There's no free money. There's no $100 bills on the pavement. So it's hard to make money, and shorting costs are part of that.
You mentioned Korea, and you said the U.S. stock market in some ways is Koreafying. What do you mean by that?
Whatever's happened in GameStop in January 21. It had been happening for many years in Korea. So Korea has, for some reason, they have this retail culture where they have what they call theme stocks. So in Korea, a theme stock is like a weird, bizarre stock that is totally untethered to reality, and people trade it all the time. And especially they have political theme stocks. So they'll just like pick some random stock and they'll say this stock is associated with this candidate. And there'll be like some plausible reason that the stock is connected to the candidate. And then the stock will just triple for no reason. And it'll like go all crazy. And then when the election comes, it'll just go back to being a normal stock. So whatever GameStop was, Korea had been doing that for many, many years. And I mean, one positive spin on that is Korea has a functional stock market, it is like a normal country. And if it's possible to have a few handful of stocks, 10 stocks every year that are weird GameStop type entities, then that's like a weird little side thing. So as I mentioned, there's no short selling in Korea. So they've legalized it on and off over the years. Right now it's illegal. So that's one reason there's so much craziness. The other aspect of Korea that is different than the US is more a retail dominated. It's like China. It's more retail dominated than the US.
I wonder how much of the gambling style is related to the fact that buy and hold may not feel as much of a sure thing or a bet, not because the markets don't do okay, but rather they look at their account and they're like, well, I never really seem to make any money on this because so many people take so much in fees. I don't know.
We talked about gambling. Gambling is mostly illegal in Korea. Like there's no casino. You can only get on horses, I think. So I think if you ask the Korean people, or maybe you ask somebody at Robinhood, why are you doing this crazy thing? They'll say, I need money. And I just don't want to, make 10% a year. I need to make 100% in a month. And so it's more like it's a get rich quick philosophy. And this is their way to get rich quick.
By the way, can you mention the Gangnam Style impact on the stock? I thought Psy was a fun story.
Okay, so again, this is just like GameStop. So there's this company, it's called the DI Corp. And it's a technology company. I think maybe it makes semiconductors or equipment related to semiconductors. So in Korea, there's lots of executives, and the executives have children, and they're these heiresses and heirs, and they marry each other. Like there's this whole soap opera of family companies. But Psy happens to be the descendant or the son of the person who runs this company. His father's the CEO and major shareholder. So this company has nothing to do with videos. It's just like a regular technology company. So Psy releases his Gangnam Style video, which went viral, and then later he had other videos like Gentlemen. And this stock became the Psy theme stock. So he didn't work there, but the stock went up a crazy amount. I forget how much it went up, but many, many hundreds of percent. So it went up when Gangnam Style came out, then it kind of went back down. Then he released another video, it went back up again. So it became this tracking stock for Psy, and his fans traded it. And it really just became totally disconnected with any rational cash flow analysis or anything like that. So that was at least 10 years before. It was whenever Gangnam Style came out. It was many years before GameStop. So that's the type of thing they do. It's not like every stock in Korea is crazy, but there's a lunatic fringe. That's what I think we're kind of heading towards in the US, where there's going to be 5 or 10 bizarre stock-like objects that trade on the stock market, but are not exactly stocks in the traditional way. They don't act like stocks.
Well, it's interesting because you've seen some of the nutty ones in the US actually, when their stock goes crazy, they do a share issuance. They're like, okay, thank you very much. We're going to issue shares, and it's going to be weird. You have this potential transformation of a garbage company into an actual company with a reasonable balance sheet that they still have to find a business model maybe, but they've transformed.
It's totally rational. It's what you should do if your stock becomes a meme stock, is issue as much equity as you want. That goes back to this discussion we had with Bubbles when we started. When the company is selling equity, that's how you know the stock is overvalued. It also relates to short sellers, because the stock gets overvalued. There's no, in Korea, you can't short sell. So who is it who's going to be selling the overpriced stock? It's the company itself. It's issuing more shares.
So do you think this is just all accruing to Citadel and Millennium? Are other institutions good investors? So
we know that the retail investors on average lose money. So whoever's not a retail investor, those people on average must be beating the market. And whether it's divided up into hedge funds versus mutual funds, pension funds versus foreign investors, I'm not sure. I would say that it is generally the case that in the long term, that some institutions, let me give you an example. I don't know much about this, but I only know what I've read about. And it's not a market that I personally am involved in. Indian options trading in India. Okay, so supposedly there's this huge retail boom in options traded in India. And I think we also know that there's this hedge fund that made $1 billion last year trading options in India. So I have no idea what the mispricing might be, but it is certainly somebody on the other side who is making money off the retail investors. And this might be a bit of a stretch, but that's kind of like a one point in time. You can also think of there's like long swings. Who made money in 1999 and 2000? It was the value investors. They lost tons of money in 99, but they made it back in 2000, 2001, 2002. So that's like a kind of a different story of like you have to be it's Warren Buffett patiently waiting for the market to swing back. So it must be some sort of mix of that like short-term crazy mispricing of Indian options in 2023 versus like long-term swings that can allow professional investors, including systematic investors, to make money.
So you mentioned AI a little bit earlier, and having lived through a handful of kind of different market regimes as a financial historian, how do you think about it?
I am a grumpy old guy, and there are a lot of things that I think are not exciting to me, like self-driving cars. I am not excited about crypto. I am not excited about the metaverse. That's some stupid idea. I am very excited about AI. Okay, so AI seems to me to be a super important economic transformation, at least as important as the internet was. So we talked about the stock market bubble of 1999. That wasn't in response to something fake. That was response to something real, which was the internet. So I think AI as a general economic, business, commercial application is going to be at least as important as the internet and probably more important. So I am not a AI skeptic who thinks that it's all overblown. There's a different thing that preceded large language models, which is just machine learning or statistical learning. I think machine learning is a basic bread and butter tool that all quants, all systematic investors should be using. And it's not as amazing and mind blowing as large language models, but it's of a similar magnitude as like regressions. So, when I went to graduate school or when I was in college, we learned about regressions. And now I think instead of learning about regressions, that there's different types of statistical models, which you could call statistical learning or machine learning.
Listeners, Owen said he's a bit of a trivia buff. He even tried out for Jeopardy once here in LA. Didn't make the cut, sadly. I'm going to give you 2 trivia questions, get your guess on. You mentioned gambling. FanDuel recently disclosed what percentage of their bets are parlays. Parlay, listener, is where you're making a multi-leg bet. So I'm betting on the Broncos to win this weekend, and I'm betting on Bo Nix to have less than 300 yards passing, and I'm betting on Cortland Sutton to score the first touchdown. So my $10 will win like 1,000. What percentage of bets do you think are parlays?
Okay, my knowledge of parlays comes mostly from the movie Silver Lining Playbook, which features an important part of the plot, 30%.
70. So basically the most lottery of all lottery tickets. There was an old stat also, I'm not going to ask you on this one because it rounds to 100, but some of the public Forex brokerages. So in the prior cycle, Forex was sort of a thing that the degenerates used to go and trade because you could get sort of infinite leverage.
Kind of like before there were zero DTE options.
Yeah, a lot of these currencies, they don't move that much, but you can leverage them up, 20, 50 to 1 intraday or whatever it was. And they disclosed that 98% of their customers lost money. So not surprising. That's not a good business model. Eventually, all your customers go broke. But at least in the FanDuel world, people seem to be reloading. I don't know when the novelty wears off.
At a casino, 98% of the customers must be losing money, but they still come back because it's fun. They're enjoying it.
Well, you get a free drink at least on that one. With the others, you might not even get any free buffet. What paper or research that you have worked on do you think didn't get as much attention? There's this one, you're like typing on it. You're like, this is going to be a banger. People are going to love this. This happens to me all the time. I'm like, this is just mind blowing. I love this topic. And then it's just crickets. Or is there anything that you've been working on where you're like, I love this idea or topic, but no one else cares?
That's every paper you've just described every paper. But, I would say, let's just go to the academic world. To me, many academics would agree there was a bubble in 1999, but there's not a lot of papers about the bubble of 2021. So I feel like I'm the only person or one of the few academics who thinks there was a bubble, not as big as 1999, but a big thing that happened in 2021. And I don't know from your perspective, wasn't just GameStop. GameStop was just like a colorful side. It was more like a huge wave of issuance. So that to me is something that strikes me as a neglected topic. I didn't necessarily do a paper about it, but it seems like a big thing.
I mean, I think when we look back on the history of it, certainly we're going to kind of shake our heads. We published a research piece as the SPACs started unfolding from Leuthold, where it said the average return of a SPAC, it was like 3 years after the SPAC, was like minus 75%. And I said, look, maybe Chamath and everyone else that are bringing high quality companies to market, but just investors, be warned that historically you're getting the garbage thrust upon you in this structure. And sure enough, it's like the number almost printed exactly if you walk forward on some of those.
SPACs are a fascinating thing because it's good to invest before they de-SPAC. So when you invest at the beginning, it's fine. It's after they de-SPAC that they turn into crappy, super overpriced IPOs. So one of the things about SPACs, like they keep inventing new stuff. Who knows what they're going to invent next? It's going to be incredible. I mean, they're constantly coming up with mind-blowing ways to separate individuals from their money.
People love talking about market efficiency and passive investing, and our market's efficient. And my favorite example used to always be, you must not know about the closed-end fund space. I would talk to listeners. I was like, because this space, like consistently, you'll see these funds that'll trade at these discounts and premiums that are just nutty. And the one we would always use was there was a Cuba closed-end fund. I think Hersfeld ran it, and they all charge like 2%. But this Cuba fund didn't invest in Cuban stocks because you can't, there are none. It invested in companies with exposure to Cuba, so like Florida Cement or whatever. But anytime it would regularly trade at a 20, 30, 40% discount. And then if something bad happened in Cuba or good happened in Cuba, however your point of view is, it would blow through to a 50% premium. You had an example that might be the gold medal winner for closed-end funds lately. You want to tell us about that one?
Sure. I mean, the Cuba one, my friend and co-author Richard Thaler has written about that one. And of course, when Obama made some announcement, I think it went to 100% premium, Cuba did. That Cuba thing is a crazy story. I wrote a piece about the Destiny 100 Tech Fund. And I think you mentioned SpaceX. They allegedly invest in private companies that have issued shares, they have written deals with. So they're advertised as a way for individual investors to participate in private equity deals like SpaceX and Stripe and things that are currently private. The ticker is DXYZ, and as I recall, the premium was something like 1,000%, and it was the world's largest recorded closed-end fund premium in history. And so I wouldn't want to overclaim and say that this is like a sign of the apocalypse or Western civilization is collapsing or the whole stock market, but it is a small little piece of evidence that sometimes things get tremendously overpriced.
I think it might have been even higher than that, but we'll qualify it in the show notes.
Maybe instead of 600, it was 6,000. I've forgotten, but whatever it was is America's highest closed-end fund premium.
And is the challenge with that fund in particular that you just don't have a developed short lending market to bring it back, or like why?
All closed-end fund, without commenting on a particular fee today, I would say whenever you see something that is tremendously overpriced, it's going to be expensive to short. And part of the reason is that whoever is buying it is not holding it in a vehicle that gets lent out. Part of it is that it might be very volatile. So it's risky to short it because if the premium is 50%, maybe you'll go to 100%. If it's 100%, maybe you'll go to 200%. So that short sellers are reluctant, even if they can short at a low cost, they're bearing risk. So I think the best way to think about it is our system is really not set up to short things. It's not set up to encourage people to short incredibly overpriced things that are very volatile, and that allows them to exist.
My producer, sort of like the presidential debates, fact-checked our DXYZ and said that it wasn't 600%, it was 2,000%. So we were low on the estimate. It was higher, much higher.
I'm batting 0% on all the quantitative questions you're putting to me.
Yeah. Well, you erred on the right side. As you think about, you go sit down with your buddies at a coffee shop in Boston, maybe getting a beer or taking a walk around the neighborhood, and you're kind of just shooting the breeze, talking about topics in our world of investing. What's something that Owen would say that 75% of your professional buddies would shake their head at and say, no, dude, we totally disagree with you on this. Like, that's silly. That's crazy. Any beliefs you have? Any ideas?
I don't know about how you want to define my professional buddies, but something that certainly I argued about with people I know this year was about indexing and passive investing. And so I would say my view would be there's too many active managers. There's not enough passive investing. More people should be holding index funds, not fewer. I get a lot of violent disagreement, especially from people who are active managers on that score.
What is the pushback?
They are buying the story that the market is broken and the index funds are distorting it and the index funds are like lazy and that there's too many index funds and the market prices are somehow wrong. So they feel like, I wouldn't say the word rigged, but they feel like because it's different than it was in 1985 when they started their career, it's wrong and it's rigged, everything's out of whack. So I don't think they have great arguments that are convincing me, but they're really receptive to the idea that there's too much indexing and prices are not where they should be for some reason.
My only thing is that the definition of passive, which to me and some of the academics has always meant market cap weighting, you have people in 2024 marketing passive as not that. You could sort stocks by CEOs named Chris, do they eat hamburgers or not, and then portfolio weight the fund by how many hamburgers they ate last year and then charge 3% a year and call that passive. But I think what you mean is just a general low-cost index market cap exposure. Is that roughly correct?
Like I want the broadest index possible. Yes.
Yeah, nothing wrong with that. We have an old picture I found of me holding the Idiot's Guide to Investing book. And I think a lot of these very basic index portfolios probably beat a lot of our friends in the institutional world, whether they admit it or not, and certainly have this cycle. We did an article called The Bear Market and Diversification, which showed that the S&P has really mowed down basically everything for the past 10 to 15 years, which has put a lot of fund managers in the fund manager graveyard. Owen, what's been your most memorable investment? Do you have one that you think about, good, bad, in between?
Well, all this talk about closed-end funds. First of all, closed-end funds are that's like from the 1800s or something. That is not the modern thing to talk about. But when I was a graduate student at MIT, this would have been like in 1992 or so, I came up with this, what I thought was a clever strategy involving closed-end funds, country funds. There's two Germany country funds. One is a premium, one is a discount. And I'm going to long the cheap one and short the expensive one, and it'll be great. I backtested, it was great. So I'm doing this with my own money. And I call up my broker and I say, I want to short this fund. And they're like, no. I was like, what do you mean? I was like, this is America. I want to short something. They're like, no shares available. So that was my first inkling that something was very different about shorting a stock than buying a stock. And later I wrote all these papers about short selling. But I think every practitioner knows there's a big difference between the textbook and reality.
Who do you put on your investing Mount Rushmore? And this more tilts towards the academic than practitioners necessarily, but in your world, who have been big mentors for you or big inspirations and impacts on your career?
All right. The finance Mount Rushmore, I'm not going to put like Keynes on there. I'm only going to be people I know. Bob Shiller, Gene Fama, Richard Thaler. Trying to think of who I'm forgetting. And I think some of those people won't be glaring at each other maybe, but I was at Chicago for many years. It was incredible to learn stuff from Gene Fama, Ken French, who you've had on your show. And it was incredible to learn from Thaler, who was also at Chicago at the time. And then I went to Yale, where Shiller was. I would say Shiller has really been, I haven't worked with him, but he's really been a major influence on all of behavioral economics, and not just for me. But those are the three names that come to mind.
I was talking to him, I think this was during the 2021 nuttiness, and it was on like a webinar or something. And I was like, Professor Shiller, do you think we take out the all-time high on the CAPE ratio, which we were close. It was like 40-ish. And I think the all-time high was like 44. And he's so wonderfully understated. You get so many people go on CNBC, like, this is going to happen with pure confidence and certainty. And he's like, I don't know, like maybe, like it might. It's like the most wonderful.
He introduced this modified version of CAPE, which is the interest rate adjusted one. So I'm not sure how I feel about that or which one is the right one to use now, but it's a pretty interesting development.
If you dig in on the modified and really actually spend some time with it,
I think it's called excess cape yield.
right, where CAPE historically is like, here's the valuation of the stock market, 10-year PE ratio. And listeners, you can go download this all online. It's free, as well as a lot of his housing and Excel stats. I think a lot of journalists kind of got this wrong on the excess yield, because what that's really showing is, do stocks look interesting relative to bonds? And so a lot of people, I think, took it as, oh, CAPE doesn't work. He's modifying it. So now you incorporate interest rates. But that's not really the way that it looks to me, at least. I think it's more, are stocks relative to bonds? And you actually talked about this, where stocks were expensive a few years ago, but bonds were not a good menu alternative. Whereas today, at least, you've got 5% or whatever it is in bonds.
The way I would put it is, in 1999, it was a no-brainer that stocks were overpriced because you could buy bonds. In 2021, some people call it the everything rally or the everything bubble. It was not obvious stocks were overpriced because interest rates were so low. So I think Shiller did not say there was a bubble in 2021. Another thing I want to mention, you mentioned Shiller's webpage. If we talk about Mount Rushmore, Shiller also has to go on the Mount Rushmore of free data for nerds. And the other people I would put on Mount Rushmore of data heroes is Ken French. Ken French has this wonderful webpage where he has the Fama French data. And I would also add Jay Ritter of Florida, who has all the IPO data, like the SPAC data that you mentioned. He doesn't exactly have raw data, but he has many, many tables and stuff of IPO data. So one wonderful thing about the internet is there's all this free data that people have made for us that we can use. And a lot of data in our lives costs millions of dollars that we have to pay every year to some vendor. This is free from Nobel Prize winners.
We have a web page that's just called Free Data Resources, but maybe we need to cobble together a full crowdsourced list of all the best resources, because there's some really good ones. Our friends at Rubico just put out some data sets. AQR's got a bunch you can download on all sorts of esoteric things, like simulated managed futures returns for 100 years and all sorts of things.
I'm going to mangle the name, open source asset pricing, whatever it's called. Nowadays, people are more interested in putting free data sets, and a lot of papers, you just automatically put the data set on your webpage when you publish a paper.
Last question before we let you go. As you look out at the rest of 2024, almost over, 2025, what are you thinking about today, or anything you're excited about or curious or confused about as you brainstorm future topics for writing? What's on the typewriter for next?
Well, the thing that happened this week is China. And China is just like the Chinese stock market went up 25% in a week or something. The Chinese stock market is kind of its own thing off over there, and not integrated into the US stock market, into world stock markets. But it's always such an incredible, bizarre wonderland the Chinese stock market is. So to me, I'm keeping an eye on the Chinese stock market just because done so many crazy things over the years, and I don't know what's going to happen. And a lot of them are not good things that have happened, or surprising things that have happened there. And there's just so much unexpected news that comes out of China all the time.
Well, it's interesting. If you look at China, for example, has had almost no equity returns for going on 30 years now or something. And more than any country that's kind of batted around from expensive to cheap. When the BRICS were going nuts in 2007, everyone wanted India and China, and they traded at a Shiller Cape of around 50. And then they've been in lockstep for the entire period since, meaning largely they've been hanging out around. China goes back and forth between 10 and 20 or 10 and 30, whatever it was. And India's kind of been in that mid-teens. But then all of a sudden, in the last year or two, India's just gone vertical, and China has gone, down, straight down. So you've had this huge divergence. So India's CAPE ratio is in the 40s now, and China, it's up, but it bottomed at single digits.
I mean, I have many thoughts about that. First of all, the Indian stock market, I know nothing about, but it's a fascinating thing. John Campbell of Harvard, who is Bob Shiller's frequent co-author, maybe he also belongs up on the Mount Rushmore there. He has written papers about the Indian stock market, and India has a lot of markets that you and I know nothing about, like the oil seed market. And there's a lot of weird stuff that's happened in India over the years, just like in China or Korea. The other thing I would say about the Chinese market specifically is there are different people who feel differently about this. But to me, a CAPE ratio in China is hard to get my head around because there's two different prices in China. There's the A shares price and the H shares price. And so there's this thing called the AH premium, which even though China has fallen tremendously, the China A shares market has fallen tremendously in the past couple of years, they're still overpriced relative to H shares, the A shares are. So it's like there should be two CAPE ratios, the ratio using the A shares price and the H shares price. And so it's a really confusing situation to evaluate when you have two different prices running around for the same country and the same stocks, two different seemingly free market prices. The H premium is 50%, and for some firms, it's hundreds of percent. So, like I say, China is a behavioral wonderland that is difficult to understand.
I'm always curious when you look at things like India and China, where a lot of my Indian friends, gold, real estate are two big allocations. They get a little of the animal spirits, to quote the professor, and start to get introduced this giant population into the investing markets. You can certainly see how they could have a pretty massive impact in prices and what happens. So it'll be fun to watch, interesting to see what happens. You've seen it a little bit with Argentina, where you have a mood shift, you got a vibe shift, a new geopolitical situation, and all of a sudden, boom, the markets can move pretty quick. What's the best place for people to read your writings, to follow along with what you're up to?
Well, just Google the word Owenomics. By the word, I didn't come up with that title. That title was chosen by ChatGPT or suggested by ChatGPT. So Owenomics on the Acadian Asset Management webpage.
Owen, thanks so much for joining us today.
My pleasure.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.